Alright, so how to find your bias. So this is going to be a very comprehensive topic, but then I'll make it as simple as possible and as easy as possible. If you're seeing this on YouTube, I'm going to target my strategy because this is the bedrock, the foundation of my strategy that makes me know where the market is going to on every trading day. Okay, so every other thing added is just entry models, blah blah blah, but this is the main thing. Okay, before I know price is going to run a buy side liquidity and sink, it's because I know the direction is down for the day. Before I trade a turtle soup for price to run a sell side liquidity and pump higher, it's because I know the direction is upside. So that's the most important thing you should ever know. So now I'm going to show you 5 different case studies, both on bullish markets and bearish markets. This would help you understand how to determine your direction for each day, regardless of what's trend or what's the market structure saying. So now let's go. We're going to start with the bull markets, okay, bullish markets. So let's see how the bullish markets. Let's talk about it. So now we're talking about case study 1 of a bullish market and how to find the draw liquidity. Now case study 1 is a particular pattern that the market will show you. Now this is useful in any time frame, okay, but now I'm going to make you understand that the 4-hour time frame first is where you have to test it first, or try to back test and study it. Why? Because it's the closest, is the smallest higher time frame. I don't know how to put it, but among the daily, weekly, monthly, 4 hours is also a higher time frame, but it's the least among them. So if you're somebody that scalps like me, the 4-hour time frame is going to be your best time frame to look for the direction of the market. But you don't use it alone, you still use it with the help of others. But then this same thing you're learning in this case study 1 is this exact same thing you're going to do when you're looking at any higher time frame. Okay, so now assuming this is an uptrend on the 4 hours, as you can see, higher lows, higher lows. Now this is my trading window, 12 p.m. GMT plus 1 to 4 p.m. GMT plus 1, which is the New York Q zone that ICT talks about. And that is in for ICT will tell you 7 a.m. Eastern time to 11 a.m. Eastern time. I mean Nigeria, Africa, West Africa. So the time zone is going to be 12 p.m. GMT plus 1 till 4 p.m. GMT plus 1. So that's a time window that you have to apply this logic. Any other time window outside of this, it will still work, but it's a lot more confusing. So understanding that this is your high low, you must have understood how to draw market structure first for you to know that this is your correct 4-hour bullish trend. Okay, so now in this case study, assuming this place is a refined internal range liquidity, or POI, it could be FVG, it could be other blocks around here. Why did I say refined? If this is the 4 hours, this zone, if you go on the 1 hour, you will find out that there is a POI in this same zone on the 1 hour. If you go to the 15 minutes, you find out that on this same zone there's a POI. If you go to the 5 minutes, you find out on the same zone there's a 5 minutes POI, to all resting inside this big zone. So it makes that place high value. Now in a case whereby price just broke structure and price is trying to retrace, this is the draw liquidity for that day. And what does this mean? Now this is what should be showing around this part on the 15 minutes time frame. If this is the 4-hour chart, then there should be a change of character, a choke. You see a high from here, we made this high, we pulled back, we made a high, and then we broke it. That's a change of character from the market going up to a market coming down. Now this pattern should be existing at this juncture here on the lower time frame. So if this structure we are looking at is on the daily, we are expecting this chalk at this area, but on the 4-hour time frame, it should be showing like this on the 4-hour time frame. If this big structure we are looking at is the weekly time frame, we are expecting this chalk to be showing at the daily time frame around this area, so you get it straight. So these signs shows that this is the next draw on liquidity, and this is where price is going for that session. Now I don't care how many FVGs and how many PDRAs you find here, whatever on this way. The one that has its zone aligning with all of that smaller time frame is the right destination that the market is coming to, and that is on period. This case study 1. So let's go to case study 2. Now case study 2. In case study 2, price has successfully retraced to that refined POI, that very nice area that is reflecting both on 4 hours, 1 hour, 50 minutes. Price has finally traded back into it. So what's happening at this point? The idea is that the next draw liquidity is high, this place. That's the next destination price is going to. And look at my trade window, 12 p.m. to this is the next place. So every other thing you do to get into this trade are called entry models, which you learn in other videos. If you're watching this on YouTube, other videos on my channel that talk about entry will help you. If you're watching this in the course, other further videos from now will help you to learn about entries. Okay, so the idea is the direction for that day is up. So anything you're doing, you're looking for bullish models, bullish entry models, everything is bullish. Okay, now let's go to case study 3. Now in a scenario whereby the market retraces to that refined POI you marked and then try to leave, but was not able to carry out that operation and started falling back to the extent it got to the base, the low of that POI, this zone, then this is a strong sign that this zone is not capable of pushing price to the draw liquidity higher. So the draw has changed. The draw is the next refined zone here. If there is no refined zone around here, maybe the zone that is showing here is only visible on 4 hours. On the 1 hour, it means nothing. It's not an FVG, it's not an order block. Okay, it's not a rejection block, nothing. On the 50 minutes, it means nothing. Then that shows you that the next draw is this blue line, not the gray line. This blue line, not the gray line. As simple as that. That's your next draw. So that day, everything you're looking for is bearish. Let's go to case study 4. So case study 4. Case study 4 is a situation whereby you came on charts and during your session, price just took out a high, an old high on that 4 hour time frame or any time frame you're looking at. Price just took out that high. Where is your next draw? It took out the high. Now I advise my students that on this particular trade pattern, you don't have a true draw on liquidity. Like, yes, there could be a draw, but you can't figure it out because on your lower time frame, you'd have this big impulse as high low method here. Anything that makes this market retrace too deep and breaks a low, a choke has occurred. Here it's going to be like a small retracement. Here a change of character has occurred, which takes us back to case study 1, whereby we would have to trade lower than existing IRL on that 4 hour time frame. So immediately your draw will change to down. Immediately it breaks here, your draw is changing to down on the 4 hour time frame. But if it refuses to break here, probably maybe return to a POI and still going up, your draw on is settled to be higher. So if this happens in your session, it's dicey. It could do it, it could do this, it could go up. So you don't want to take trades like this. You want to avoid this kind of day. If this shows up, you are avoiding it. You're coming to the next session. So if you're on London session, now London session in Nigeria here is 7 a.m. GMT plus 1 till 10 a.m. GMT plus 1. In Eastern time, actually says 2 a.m. Eastern time till 5 a.m. Eastern time. Now if you're coming to the charts by this time, which is London, and you see this thing, you can just come back by New York. Now if by New York that choke has happened here, then you know that the draw is now lower. But if by New York the choke did not happen, if the price is still climbing higher, then it becomes clearer that it seems this is the real draw. As simple as that. Let's go to case 5. So case 35 is a scenario whereby the market has broken a previous high before, but not on this trading session. let's say it happened either if you're on if this is the London session, maybe it happened the previous day. It broke structure here the previous day. If this is New York session, maybe it happened during London, but it has already happened before. On this day, my bias is not dicey like case 4, that is could break chalk here and come down. Or this, in this case, my bias is 80 to 90% sure that we are still going to continue higher, because the market is joined to a very important liquidity pool above, and it's either going to be a weekly high, a daily high, a monthly high, something very, very powerful that is resting above the price is chasing. The price doesn't have any time to start retracing to any IRL down. It just keep going higher and higher. So days like this, it's clear that that's your draw, and that's case 5, and that's the last case study. Now we'll talk about different examples, but then we'll go to the bearish market. Okay, so in the bear market, you're going to see for yourself it's still the same thing, but then we have flipped it upside down. So let's see. For the bearish market case study 1, the same thing like when I showed you on the bullish market, price is going down, breaking to the downside on the 4 hour, for instance, and now there's something like a retracement. Price is trying to go higher, trying to retrace on the 4 hour, but on the 15 minutes it's showing you this, practically a chalk, a low, went up, continued lower, then later broke the high that led to this low. That's a change of character. So this means that your draw on liquidity is a refined IRL or POI on the 4 hour resting here. You know what that means? This POI have other smaller POI zones resting inside. That's the next draw on liquidity. This is the case study 1 for bearish markets. Now this is case study 2. In case study 2, price successfully got the refined IRL POI, and then price is leaving there. It's showing signs that we are to drop. We are to drop. That's the next draw down. This is the DOL for that day, for that session that you're looking at, that this is occurring. Now case study 3 is when that place price retraced to, price later dropped down and then started going back inside above again. It shows that here is not powerful enough to send it to this draw. So therefore it's seeking a higher draw that will make it come lower, but you don't care. You want to trade that session, that 4 hours. You just want to trade to the next high value area. You don't mind whether it wants to keep going higher or come down. So the next possible place is coming. If there's another refined POI around here, yes, it will come for that. If there is none, it's coming for this high, period. That's the next place price is going to. So our direction is what? Above, up. Case study 4. In case study 4 for bearish markets, this is a scenario whereby in that your particular session, price just reacted from this and dropped to that drop, to this low. Now where is the next draw? Now this is dicey, just like the other case study for bullish markets. Immediately a chalk happens there, if price retraces on the lower time frame, which is 15 in this case, and breaks here, your draw is going to be up. But if it keeps going down, your draw is going to be down. So it's dicey, right? So what do we do in such case? We avoid either this pair or this session and go to the next session. In the next session, if that chalk has happened, you know that okay, price is going higher. In the next session, if that chalk did not happen, rather price is still aggressively going down, then it means it's still seeking a very important liquidity pool that's resting beneath. Simple and short. That's it. Very straightforward. So let's go to the case 35. Case 35. This is when the break of structure happened on either the previous day or the previous session, and you're coming into your session or into this day, see that it has already happened before. This has a low chance of causing a chalk here that will make it retrace on the smaller time frame. It has a lower chance. So it means price is what? Drawing is going to draw aggressively to the draw liquidity down. So on this day your draw is lower, it's lower. So we are going to go into chart examples. I will show you different random chart examples, and then we'll see if we can pair it to any of the case studies. So if you're watching this video, go back and look at all the case studies and screenshot them and keep. When I open any chart example, you look at which one that matches, you know that this is the one that matches, and now this is the direction. Attach your entry model to this and see how you make money. So let's get right into it. Now take a look at this example I'm showing you right now. So this is the most recent high on the 4 hour, and there is no established 4 hour low yet. The previous low that was broken on Friday, as I when I'm shooting this, and when today's price action is Monday, this is Friday, and that's when it did a breaker structure. So we have not gotten any low yet, and as you can see, I have a buy position on right now. So now let's see what case study this pattern falls on. So let's see. Now it falls on the bearish case 35, whereby the break of structure happened the previous day or session or whatever, but this is my trading session between this line and this line, and this is what the smaller time frame is doing. So in this case, the draw is not like, the draw is supposed to be, the draw is supposed to be down normally, right? But it can't just be down like full stop, like one direction alone. Why I highlighted this lower high lower low movement is because when price breaks the previous high on the 15-minute time frame, then it means price is going to expand back into the range. So that's the exact kind of setup whereby if we mainly break this high, the draw liquidity is going to be back into the range, okay, into the 4 hour range. That is going to be higher, not lower anymore. But if it doesn't break, draw is going to be down. That's exactly the case study. So let's see the 15 minutes time frame of that trade. Now this is the 15 minutes time frame of this trade. As you can see, if you check how it's moving, you see that it's having the step I talked about, and we just did this. Now I set my buy stop order. Now buy stop order is a pending order that you set above the previous high or at a particular point in the market, whereby if the market hits it, a trade order will activate. Like now I set a buy stop here. If price hits it, my buy order is now active. Now I set it up there because I know if price breaks this high that led to this low, we are going to trade back into the range. So we are trading back into the range, and that's why I'm in this buy trade. So let's move on to another example. Now let's take a good look at this setup. So this Euro USD 4 hour time frame again, and what's our current dealing range? This high and this low on the 4 hour. Now in as much as this is not an established 4 hour high, which we're going to go and verify from the 15 minutes, in as much as this is not an established 4 hour high, we are not going to trade lower back into the range. This is the draw. So anything we are doing right here with the entry models, whatever, this is the draw liquidity. Price is going to go up. Okay, so we'll see the 15 minutes on, or we'll see the particular price pattern that matches with this. Now this is the exact price pattern that suits it. You can see the break of structure happened a day before, or before my trading time, my trading period. So what is that? This is a bullish case 35. Okay, so in this scenario, the draw is higher, provided this 15 minutes structure has not been validated, has not been broken. If it gets broken here, we'll trade back into the range, just like the previous example we did, but inverse. If we keep going higher, this is the draw, and that's where price is going to go to. Remember, this high is not an established high. Even if it curves, this 4 hour place, even if it curves down, if the 15 did not do a choke around that area, then we are not going to consider price trading back into the range. It won't just work like that. Okay, so let's take a good look at it again. As you can see, the break of structure happened before. It looks like it's curved down, but then there was no 15 minutes chop around there. So let's still look at the 15 minutes time frame around there. So look at 15 minutes. Now if you look at the 15 minutes time frame around here, you find out that this place is leading to the high. Can you see that there was no chalk? For a chalk to be formed, this low has to be taken out on 15. That will call a chalk, but all of these things, they are not chalks, and that's why the market was still bullish, and that's why the buy trade worked out. Okay, so that's what you should understand. This clear example, okay. So we have this clear example we see right here on Euro USD 4-hour time frame. As you can see, we just made a 4-hour high here, and then we are retracing. We saw this big drop that happened here. Why did it happen? Now when this high became an established 4-hour high, which is causing a 15 minutes chop around here, we were going to be trading towards all the IRL or all the POIs we have internally inside this range. These are dealing range, this high and this low, and in as much as that's our dealing range, everything we're going to do inside here everything we're going to do is to trade towards these areas. Now the main area that is the main catch where price is going to draw to are the areas that support smaller time frames too. Like this area now have an FVG that's been mitigated before, and there's a clear sign that this FVG would not cause price to reverse higher. It's going to cover, so no need of marking it. They're looking for the place where price will draw to and maybe stop or try to start reversing from again. So FVG here plus other block, I'll just mark all together. As you can see, the 15 minutes, let's see if the 15 minutes also supports that area, and as you see, the 15 also supports that area, so it means the market will draw to that point. So that's exactly how you know your draw is going to be lower. When did the chalk happen? Now let's see the exact day the chalk happened, because this drop lasted for some days. So the exact chalk happened on this day right here, on the 15 minutes. That's the chalk right here. So after it has happened, I'll use a different color here. After it has happened right here, so what are we going to do next? So after it has happened right here, it means both that day, this day, all bearish. And what particular pattern of what chart case study did it match with? So let's see the case study match. Alright, so this is another case study I was trying to talk about. So in this case, we made a high. Okay, forget that it's actually red, but it was green before. Feel me? Now it's actually on replay mode. There was a reason ahead that made the market structure make this red, red. But if you're looking at that in real time, it's gonna be real. It's gonna be green. But whatever the color, if this high, whatever time frame you're looking at, this high is established for that time frame, and then price trades back into a POI successfully, which is the former case study we just talked about, and then enters the POI that matches with all the smaller time frame POIs, as you can see here, and then start pulling up. The next draw is this high. That's the next draw. That exactly is the next draw. So price might play around and get there. Now how are you going to get into this trade? You learn that later on, but you need to understand how this draw liquidity works. From here, we are headed to the next place. It's just okay. This will help you understand all the draw liquidity and daily buyers videos you've watched before now. Okay, so now the next video is going to teach you about the checklist to use, because see, look, do the same thing on the monthly, weekly, daily, 4 hours. These are your higher time frames. These are your draw. Now if the weekly and daily is in line with the 4 hours, very high probability trade. If it's only 4 hours, not high probability trade. If it's only 4 hours, I tell you, okay, this is a draw. Yes, 4 hours is a little time frame, you have to believe the most amongst all of them. But if others back you up, then very high probability trade. Is only 4 hours, it's not too high, but it will work. It might not too. And if daily and 4 hours, then it's a medium probability trade. Like it's also good, very good too. So yes, this from 1 hour down is you scouting for entries. Okay, the 1 hour will give you the time frame, the 1 hour will give you the POI you're going to work with, whether it's discount or premium above midnight or below midnight. The 1 hour will give you that POI, and the 15 minutes give you the, and 15 and 5 give you the direct entry. So that's what the whole system is made up. Extremely easy. Okay, so let's move to the next video.